Hi, my name is Patrick Richter, Partner and Managing Director. We hope you find the following 5-minute explanation of how to distribute out of your PST and savings plan helpful and informative. This content is designed to be short and easy to understand, as it is impossible to cover all areas of distribution planning in 5 minutes. Please feel free to contact us with any additional questions. As one of the 4 key pillars to Procter & Gamble financial planning, your P&G PST plan and savings plan can have an enormous impact on your overall retirement. We cannot stress enough how important it is to work with an experienced professional when distributing out of the plan. Unfortunately, we have seen many mistakes made even by well-respected financial advisors who are simply not experienced or well-versed in the Procter & Gamble plan. The best way to explain the distribution strategy most commonly used by P&G retirees is through an illustration. This is referred to the qualified lump sum distribution, where we utilize net unrealized appreciation. Many of you may have come to know this strategy as NUA. We begin with adding up the totals of all PST and savings plan balances. In this example, let's start with $2 million. It is important to note that if you do not turn age 55 or older in the year you leave P&G as a qualified retiree, there are some things to be aware of that we do not have time to dive into during this session. Please contact us for details. So we are assuming a 55-year-old is leaving P&G as a qualified retiree. They have made sure not to take any ad hoc withdrawals out of their PST plan and have elected to distribute from the PST and savings plan all at once as a qualified lump sum distribution. Let's start with the preferred shares inside your PST plan. These preferred shares carry a very low cost basis, only $6.82 per share. To calculate the amount of taxable income that will be created when you distribute out of the PST plan, simply multiply the number of preferred shares you have by $6.82. In this example, there are 5,555 shares of preferred P&G stock. This will create taxable income of $37,885. Simply 5,555 times $6.82. The tax paid will depend on what other income the taxpayer has in the same year. We'll cover tax planning in another webinar. Assuming, for this example, a 25% federal tax rate, total tax owed on $37,885 will be $9,471. Not a bad price to pay for what will now be 5,555 shares of P&G stock held outside of a retirement account. Why would we want to pay any taxes and take money out of the PST plan? Number 1, lower taxes. Both P&G dividends and P&G stock sales will be treated at the usually lower qualified dividend rate and long-term capital gain rate. This, in almost all cases, is lower than the ordinary income tax rate where IRA withdrawals are taxed at. In another webinar, we'll cover even the possibility at enjoying some capital gains at no federal tax. Number 2, we avoid IRA required minimum distributions on all the preferred shares that are no longer in a qualified retirement account. This can be a big advantage to lowering your tax bill after age 70 and a half, when the government starts forcing you to make IRA withdrawals. Number 3, great for charitable giving. It is almost always better to give appreciated stock in lieu of cash to qualified charities or 501c3s. When giving appreciated stock, you receive a tax deduction for the fair market value of the stock up to 1/3 of adjusted gross income. And the charity can sell the stock tax-free. A great win with stock that was previously held in an IRA account. Number 4, something we call tax diversity. One thing we do not know is what the future tax landscape will be. We do know that the only way to prepare for an ever-changing tax landscape is to remain flexible. Creating another account outside of your IRA allows you to create flexibility when withdrawing from your assets in retirement. While we have talked a lot about the benefits of taking money out of the PST account in lieu of rolling everything to the IRA, there are benefits in rolling all non-preferred stock and other PST and savings plan holdings to an IRA at the same time as you take out the preferred shares. Throughout this process, you can elect to keep your P&G shares as they roll to your IRA. They do not have to be sold. It's very important. The decision to distribute from the plan does not necessarily mean selling P&G stock. You do, however, need to liquidate all non-Procter & Gamble holdings and roll the cash to the IRA. With this strategy and using our previous example, $1.5 million of the $2 million would roll to the IRA, of which let's assume there are 3,600 shares of P&G common stock. If the stock is around $83 per share, that would leave approximately $1.2 million of cash in the IRA to invest. So out of $2 million, $1.5 million rolls to the IRA, of which $1.2 million is cash. The IRA provides many benefits. 1, continued tax deferral. You can now sell all your P&G common stock immediately without any tax consequence or at your leisure. Number 2, if you've never been able to put money before into a Roth IRA because of income limitations, you do have the possibility to put money into a Roth IRA through Roth conversions if you have IRA dollars. Number 3, a very efficient asset to leave to charity at passing. We talked about appreciated stock being great to give during your life. An IRA or a portion of your IRA is a great asset to leave to a charity because you avoid all tax. We want to remind everyone, due to time, this process has been very condensed. It has very important distinctions and steps. Please contact us for help in the distribution process. Also, we're happy to walk you through the mechanics of the Frank Duke strategy as well.